Preparing for an investment compliance analyst at State Street interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does an investment compliance analyst do in an asset servicing firm like State Street? An investment compliance analyst protects the portfolio from breaching client or regulatory limits. At State Street, I would monitor holdings, trades, cash, derivatives, issuer exposure, and concentration limits against agreed guidelines. When an exception appears, I would validate the data, determine whether it is a true breach or false positive, document the analysis, and escalate under SLA. The role connects investment operations, custody data, portfolio managers, and client reporting. While answering, focus on monitoring client portfolios against mandates, regulations, and internal rules, plus exception investigation, escalation, reporting, and the importance of accurate holdings and reference data. Question 2. How would you explain pre-trade versus post-trade compliance monitoring? Pre-trade compliance happens before a trade is executed. It checks whether the proposed order would breach investment guidelines, such as issuer limits, restricted securities, or asset allocation bans. Post-trade compliance happens after execution and validates the actual portfolio. In a servicing environment, post-trade is critical because breaches can arise from market movements, corporate actions, pricing changes, or late data. I would treat both as controls, but with different timing and urgency. Make sure to cover timing, objective, stakeholders, and examples. Mention that pre-trade prevents prohibited trades, while post-trade confirms portfolios remain compliant after execution. Corporate actions, market moves, or data updates. Question 3. If a portfolio breaches a 10% issuer concentration limit, how would you investigate it? I would first confirm the rule calculation, numerator, denominator, market values, issuer hierarchy, and any look-through requirements. Then I would compare current exposure against prior days to see if the breach came from a trade, price movement, cash flow, or corporate action. If data is wrong, I would raise it with the data team. If it is a true breach, I would document evidence, classify it as active or passive, and escalate according to procedure. In your answer, talk about recalculating exposure, checking market value, issuer mapping, corporate actions, passive versus active breach, guideline wording, documentation, and escalation to the appropriate party. Question 4. What is the difference between an active breach and a passive breach? An active breach is caused by a deliberate action, such as a portfolio manager buying a security that violates a guideline. A passive breach happens because of external factors, like market price movement, rating downgrade, index rebalancing, or investor redemptions changing portfolio weights. The distinction matters because active breaches usually require urgent escalation and remediation. Passive breaches still need monitoring, documentation, and a plan, but the client or mandate may allow a cure period. Be sure to mention cause, accountability, remediation expectations, and examples. Active breaches usually result from investment action, while passive breaches arise from events outside direct trading decisions. Question 5. How do you interpret an investment guideline before coding or testing it? I start by translating the guideline into testable components. For example, if the mandate says no more than 5% in below investment grade bonds, I need the rating source, hierarchy, portfolio denominator, timing, and treatment of split-rated securities. I also look for exceptions, grandfathering, and cure periods. If wording is ambiguous, I do not assume. I document the interpretation and seek confirmation from compliance, the client service team, or portfolio management. While answering, focus on reading the mandate carefully, identifying measurable limits, exceptions, definitions, data sources, calculation frequency, ambiguity, and the need to confirm unclear wording with stakeholders. Question 6. What types of investment restrictions are commonly monitored in compliance systems? Common restrictions include issuer concentration, sector exposure, country limits, credit rating floors, maturity limits, duration bands, asset class eligibility, cash minimums, and derivative exposure. Some mandates also include counterparty limits, restricted security lists, ESG exclusions, leverage caps, or UCITS diversification rules. In practice, the challenge is not just knowing the rule. It is ensuring the holdings, classifications, prices, ratings, and issuer data feeding the rule are complete and accurate. Make sure to cover issuer, sector, country, rating, asset class, liquidity, derivatives, currency, counterparty, restricted lists, ESG exclusions, and client-specific mandate rules. Question 7. How would you handle an exception that you believe is a false positive? I would treat the alert seriously until I can prove it is false. First, I would check holdings, prices, security classification, issuer mapping, ratings, and the rule setup. Then I would compare the system output to a manual calculation. If the exception comes from stale data or incorrect coding, I would document the evidence, raise a correction request, and close it only under the approved workflow. A clean audit trail is essential. In your answer, talk about not dismissing alerts too quickly, validating data, reviewing rule logic, gathering evidence, documenting the reason, and communicating clearly before closing the exception. Question 8. Why is reference data important in investment compliance? Reference data drives the compliance result. A bond may pass or fail a rule depending on its issuer, rating, maturity, country, sector, security type, or collateral classification. If any of those fields are wrong, the system may create a false exception, or, worse, miss a real breach. That is why I would always investigate data lineage, source priority, and recent changes before concluding on an alert. Good compliance depends on good data. Be sure to mention security master data, issuer hierarchies, ratings, sector and country classifications, derivatives attributes, data quality controls, and how bad data can create missed breaches or false alerts. Question 9. How would you prioritize multiple compliance alerts near a reporting deadline? I would prioritize based on risk and deadline. Regulatory breaches, hard investment restrictions, client reportable items, and large exposure exceptions come first. Then I would review aging items and alerts tied to imminent reporting deliverables. I would communicate capacity constraints early, keep stakeholders updated, and avoid closing alerts without evidence just to meet a deadline. In a State Street-style servicing role, SLA discipline matters, but quality and auditability matter just as much. While answering, focus on risk-based prioritization, materiality, regulatory versus client rules, SLA deadlines, breach severity, aging exceptions, communication, and avoiding rushed, unsupported closures. Question 10. What do you know about UCITS investment restrictions? UCITS rules are designed to protect retail investors through diversification, liquidity, and risk controls. A common concept is the 5-10-40 rule, where exposure to one issuer is generally capped, and larger positions are limited in aggregate. UCITS also has rules around eligible assets, derivatives, counterparty exposure, borrowing, and concentration. In an interview, I would not quote rules mechanically. I would explain that the prospectus and local implementation must be checked before monitoring. Make sure to cover diversification, eligible assets, issuer limits, 5-10-40 rule concept, derivatives exposure, liquidity, risk spreading, and the need to verify the fund's specific prospectus wording. Question 11. How would you monitor compliance for fixed income portfolios? Fixed income compliance focuses heavily on credit quality, duration, maturity, issuer exposure, sector, country, currency, and eligible instrument rules. I would also watch downgrades, because a bond that was compliant at purchase can become non-compliant later. For derivatives, I would check whether exposure is measured by notional, market value, commitment, or another agreed method. Fixed income portfolios need careful data validation because ratings, maturities, and issuer hierarchies directly affect compliance outcomes. In your answer, talk about rating limits, duration, maturity, issuer and sector concentration, currency exposure, sovereign versus corporate treatment, derivatives, pricing, amortization, and downgrade-related breaches. Question 12. How do derivatives create challenges for investment compliance monitoring? Derivatives are challenging because the economic exposure can differ from the market value on the balance sheet. A futures contract may have low market value but large notional exposure. Swaps may require counterparty, underlying, currency, and leverage checks. Options introduce delta or scenario-based exposure, depending on the rule. My first step would be to understand the mandate calculation basis, then verify instrument attributes and exposure methodology before concluding whether the portfolio is compliant. Be sure to mention exposure measurement, notional versus market value, underlying look-through, leverage, counterparty risk, collateral, netting, valuation, and whether mandate language specifies the calculation basis. Question 13. What steps would you take when a credit rating downgrade causes a breach? I would confirm the downgrade with the approved rating source and check the mandate's rating hierarchy, especially if multiple agencies are used. Then I would calculate the affected exposure and determine whether the breach is passive because it resulted from a rating event, not a trade. I would review any cure period or grandfathering language, document the timeline, and escalate to the client or investment team. Until resolved, I would track and report the exception consistently. While answering, focus on confirming the downgrade source, rating hierarchy, effective date, mandate language, passive breach classification, cure period, client notification, and ongoing monitoring until remediation. Question 14. How would you communicate a compliance breach to a portfolio manager or client service team? I would communicate clearly and factually. The message should state the rule breached, current exposure, allowed limit, date identified, likely cause, and supporting evidence. I would avoid blame and focus on resolution, whether action is required, whether a cure period applies, and when an update is needed. For example, I might say exposure to issuer X is 10.8% versus a 10% limit after price movement. That keeps the discussion objective and actionable. Make sure to cover concise communication, facts over blame, rule breached, exposure amount, cause, evidence, urgency, required action, SLA, and maintaining a professional audit trail. Question 15. What is an investment compliance breach log, and why is it important? A breach log is the control record for compliance exceptions. It captures the rule, portfolio, date identified, exposure, cause, classification, escalation, owner, remediation status, and closure evidence. It matters because compliance work must be auditable. If a regulator, client, or internal audit asks what happened, the log should show the timeline and decisions. It also helps management identify recurring issues, such as bad data, rule coding gaps, or late trade files. In your answer, talk about recording exceptions, dates, cause, ownership, evidence, status, remediation, client reporting, audit support, trend analysis, and operational accountability. Question 16. How would you test whether a newly coded compliance rule is working correctly? I would begin with the approved guideline interpretation and convert it into test cases. A good test includes a passing scenario, a failing scenario, and edge cases such as exposure exactly at the limit. I would manually calculate expected results using holdings and reference data, then compare them to the system output. If results differ, I would check rule logic and data inputs. Before go live, I would document testing evidence and obtain appropriate review or sign-off. Be sure to mention reviewing requirements, creating test cases, manual recalculation, positive and negative scenarios, edge cases, source data validation, peer review, sign-off, and documentation. Question 17. Tell me about a time you had to investigate a data discrepancy under time pressure. In a time pressure situation, I would keep the investigation structured. First, I would isolate the discrepancy, holdings, price identifier, rating, or classification. Then I would compare source files, system records, and prior day values to identify the break. I would communicate interim findings rather than stay silent until the end. If the issue affects reporting, I would escalate early with impact and options. The key is speed, but not guesswork. While answering, use a star structure. Emphasize prioritization, reconciliation, root cause analysis, stakeholder communication, documentation, and how you balance speed with accuracy. Question 18. Why do you want to work in investment compliance at State Street? State Street sits at the center of institutional investing, so an investment compliance role offers exposure to portfolios, regulations, data, and client servicing at scale. I like that the work is analytical, but also control-focused. You need to understand markets, interpret rules, investigate exceptions, and communicate clearly. State Street's custody and asset servicing platform makes data quality and operational discipline especially important. That combination fits my interest in finance, risk, and process improvement. Make sure to connect State Street's asset servicing scale, institutional clients, custody and data strengths, operational risk control, career learning, and your interest in markets, regulation, and analytical problem solving. Question 19. How would you ensure accuracy when monitoring many portfolios every day? I would rely on a disciplined daily process. That means reviewing exception queues, checking data completeness, reconciling key inputs, prioritizing high-risk alerts, and tracking open items. I would use checklists and procedures to avoid missing steps, especially when volumes are high. For complex or material items, I would seek peer review. Over time, I would look for recurring false positives or manual bottlenecks and suggest improvements so the process becomes more accurate and scalable. In your answer, talk about checklists, exception queues, reconciliations, data controls, prioritization, maker-checker review, aging reports, procedure adherence, automation, and continuous improvement. Question 20. What would you do if you disagreed with a portfolio manager's view that an alert is not a breach? I would keep the discussion professional and evidence-based. I would return to the mandate wording, the approved rule interpretation, and the calculation behind the alert. If the portfolio manager has additional context, I would consider it and validate it, but I would not close the exception simply because someone disagrees. If uncertainty remains, I would escalate through the compliance or client governance process and document both positions. Controls only work when they remain independent. Be sure to mention professional challenge, evidence-based discussion, mandate wording, independent calculation, escalation protocol, documentation, respect, and not overriding controls without proper approval. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.